Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave yes in the comment, and we are here to help you obtain insight and build wealth. The book we are going to share today is Strategic Risk Management by Campbell Harvey, Sandy Rattray, and Otto Van Hemert. What's in it for me? Techniques to build portfolios that are resilient to financial crises and market shocks. As an investor, you want to be able to protect your portfolio from severe, unexpected market downturns, right? That's exactly what we'll be exploring in this chapter to Strategic Risk Management, scientifically backed strategies aimed at limiting losses during a crisis. First, we'll cover resilient investment strategies like trend following. Next, we'll explain advanced risk management methods like volatility targeting and strategic rebalancing, showing how to further insulate your portfolio. Finally, we'll look at how these integrated strategies outperformed traditional investments during the pandemic-induced crash. Crisis Alpha. Let's talk about Crisis Alpha. This strategy is all about generating extra returns when the market hits a rough patch. Trend-following strategies come into play here, dynamically adjusting risk to keep those returns safe. These strategies involve selling when the market drops and buying when it rises, all to catch momentum across different types of assets, from stocks to bonds and commodities. But there's a question lurking: can they still work if government bond yields start to climb? Research suggests that trend following in bond futures has a solid track record of protecting against tail risks. This happens because bonds often move in a different direction than stocks. If you were to remove the exposure to trends in the bond market, you might lose some of that downside protection. The thing to remember is that trend following isn't limited to just stocks, it can work wonders for government bonds too. Its power comes from the diversification across different types of assets. Sticking to non-equity markets only might not give you the best drawdown protection. Some folks might still be skeptical about whether momentum strategies can stay profitable, but it's a proven fact that diversified trend following has been delivering crisis alpha for over half a century. So, for portfolios looking to weather crises, adaptive systems designed to reduce risk and keep those returns coming are a promising path forward. Before we continue, if you are interested in this topic, please consider subscribing and give us a thumb up. Let's continue. A crisis-proof portfolio. The holy grail for investors is a crisis-proof portfolio, one that holds strong in the best and worst of times. Unfortunately, unless you're clairvoyant, you're going to be vulnerable to unpredictability. But there are a variety of tools and strategies you can use to safeguard your portfolio during significant stock market downturns. Continuously holding short-dated put options is a reliable strategy, but it can be expensive. Another approach is holding safe haven treasury bonds, which can generate positive returns but may not perform well during crises. Long positions in gold and credit protection can be moderately reliable and cost-effective. Dynamic strategies may be a better choice. Options like momentum and shorting currency carry can be adapted to changing market conditions. And effective passive strategies include holding 1-month S&P 500 put options, which are great during crises but come with a price tag, and long credit protection. The question that often arises is whether it's possible to make a portfolio entirely crisis-proof. Because there's a direct trade-off between security and cost, chances are you can't afford a completely crisis-proof portfolio. But you can create a crisis-resilient one. Passive option strategies tend to be expensive for most investors. However, historical data suggests that futures time series momentum and long-short equity strategies have performed relatively well. The key is achieving positive returns during market downturns without incurring excessive costs during stable times. If you're an investor, you should also consider potential drawdowns, the declines in investment value from their peak to trough, in crisis-oriented strategies. Even though these strategies can provide overall portfolio protection, it's essential to weigh the trade-offs between reliability during crises and costs during normal market conditions. Achieving a crisis-proof portfolio requires a combination of passive hedges like long credit protection and dynamic strategies like time series momentum to help mitigate drawdowns sufficiently to justify the expenses. While perfection may be elusive, being prepared with diversified crisis alpha potential for different market conditions is a wise approach. Risk Management Strategy 1: Volatility Targeting. Investment strategies aren't the only way to crisis-proof your portfolio. In this section, we'll discuss how using volatility targeting can give your portfolio some crisis protection. The basic idea is to keep your portfolio's volatility steady at a set target level. You do this by adjusting how much leverage you're using as volatility changes. There are two key things about volatility that make this work: it tends to persist, and it's negatively related to stock returns. By targeting volatility, you can counter its fluctuations. This can get you higher risk-adjusted returns, make extreme price swings less likely, and result in smaller drawdowns. Volatility tends to keep doing what it's been doing. High volatility in the past means high volatility in the near future. So when volatility rises, the targeting strategy reduces leverage to control risk. When volatility falls, leverage is boosted to maintain the target. For stocks, volatility and returns tend to move in opposite directions. So these strategies increase exposure after the price drops, when volatility spikes. This provides some of the same crisis protection as those momentum strategies we talked about earlier. Volatility targeting provides risk management while also improving risk-adjusted returns. By working against volatility fluctuations, huge price swings and volatility spikes become less likely. Maximum drawdowns also get smaller for balanced and risk-parity portfolios, since smoothing out volatility smooths out the ride. Put simply, by adaptively managing volatility, your overall portfolio stability improves. In the next section, we'll look at a second risk management strategy called strategic rebalancing. Risk Management Strategy 2: Strategic Rebalancing. Another way to mitigate risk is by rebalancing your portfolio. This is far from a quick fix. In fact, it can result in a portfolio that underperforms. On the flip side, a pure buy-and-hold approach lets your asset mix drift over time, so it loses diversification. That's why it's important to find a balance. A stock-bond portfolio that's rebalanced monthly tends to underperform buy-and-hold during prolonged bad times for one asset class. For example, a 60-40 stock-bond portfolio rebalanced monthly loses more than buy-and-hold during long stock market slumps. The reason for this is that mechanical rebalancing sells winners and buys losers, creating a concave yield curve. But you can counter this by incorporating considerations like using monthly cash inflows and outflows to gradually move your asset mix back to target allocations, or adding exposure to stock bond trends. You can also diversify across more, including international, asset classes, and allocate to broad trend strategies that can profit from macro asset trends when equities are distressed. In short, strategic rebalancing takes regular portfolio rebalancing to the next level. Done right, it manages risk instead of just letting asset drift drive your diversification. When you combine rebalancing with momentum and diversification, you can turn a potential drawback into an advantage for managing drawdowns. Risk Management Strategy 3: Drawdown Strategies. You can't maintain a healthy portfolio without factoring in the human element. Investment management isn't like riding a bike. You can lose skills. Whether it's because of abrupt changes in the market or personal factors, you may at some point have to hire, move, or fire a manager to the benefit of your portfolio. Making this decision is directly connected to drawdowns, so that's what we're going to focus on in this section: strategies for reducing risk when dealing with investment managers. Drawdowns, as you've learned, refer to how much an account has fallen from its peak to its trough. They serve as a quantification of the potential downside risk of an investment. A larger drawdown indicates the possibility of more substantial losses. For example, a 20% drawdown signifies that an initial investment of $10,000 has decreased to $8,000. Monitoring drawdowns can help you in making informed decisions to mitigate these losses. When a portfolio undergoes a significant drawdown, it's crucial to assess whether you should maintain or change investment managers. This evaluation involves weighing the risks associated with retaining an underperforming manager versus prematurely parting ways with a successful one. As drawdowns are challenging to predict, it's essential to establish reasonable limits based on return distribution parameters. Preset drawdown rules can help curb excessive risk-taking. Clearly communicate these drawdown limits to incentivize managers to manage risk prudently. You can also implement automatic deallocation at a predefined level as a failsafe against last-minute, high-risk decisions. Just remember that there are two primary types of errors: the failure to retain talented managers and the failure to dismiss underperforming ones. Calculating the costs of these errors can guide your decisions regarding hiring and firing. Total return rules are the most effective way to assess managers' consistent ability to generate positive returns, while drawdown rules specifically address abrupt skill deterioration scenarios. Consider adopting a time-varying drawdown rule. After all, hitting a certain drawdown level becomes more likely over time, even if the manager's skill remains constant. 2 approaches to fund management. You now know that managing risk to your portfolio requires investing strategically, employing risk mitigation strategies, and making sure your investment manager is on top of their game. Next, we're going to explore systematic versus discretionary approaches in hedge funds, and the risks associated with each style. Systematic funds employ algorithmic, rules-based strategies. Discretionary funds, on the other hand, rely on human expertise and real-time insights. Historically, systematic and discretionary equity and macro strategies have achieved similar risk-adjusted returns on average. So why are so many investors skeptical of systematic strategies? Well, it's just that different market inefficiencies suit each approach. Systematic strategies excel with large datasets, risk management techniques like portfolio diversification, emotionless decision-making, back-testing algorithms, and high-frequency trading. Discretionary strategies better exploit fundamental analysis, market sentiment, short-term volatility, qualitative risk assessments, tailored objectives, and private equity deals. Different hedge fund types are vulnerable to different types of risk. For example, equity long-short funds can be affected by company news or media events. Meanwhile, long-biased funds can be highly sensitive to the performance of key holdings. Every hedge fund is composed of unique combinations of strategies, and so is susceptible to unique combinations of risk. In essence, systematic strategies thrive with data-driven, technical analysis, while discretionary strategies are ideal for fundamental, qualitative assessments. Rather than viewing one or the other as inferior, try to cultivate a balanced perspective that recognizes their complementary strengths, and align your choice with your objectives, horizon, and risk profile. Putting strategy to the test. The quantitative strategic risk management framework we've outlined in this chapter was put to the test during the COVID-19 pandemic. This period created an out-of-sample stress test as equities experienced a severe drawdown, and proved that these quantitative approaches can effectively function during real-world extremes. First, the performance of various investment strategies was assessed. Allocations to trend following and certain long-short equity strategies focusing on quality and profitability proved effective during the drawdown. These positive convexity approaches lived up to their promise of providing crisis alpha. Second, volatility targeting strategies were examined. As both a risk management technique and investment strategy, volatility targeting shone during this period for equity and credit exposures. Portfolios using this approach substantially reduced drawdowns compared to traditional investments. Finally, rebalancing methodologies were tested. A conditional rebalancing approach, which delayed rebalancing during market downtrends, significantly outperformed mechanical calendar rebalancing. This provided further validation of strategic rebalancing techniques. The pandemic provided empirical evidence showing that separating investment and risk management isn't optimal. It also demonstrated that many traditional risk metrics exhibit poor alignment. The solution, as you've learned, is an integrative risk management philosophy. Combining investments and risk management via advanced methods like trend following, volatility targeting, and strategic rebalancing can substantially mitigate drawdowns, even in an unprecedented crisis. That's the end of today's sharing. If you like our content, please give us a thumb up and share it with your friends. See you next time.